evening, everyone, and thank you so much for being here. I want to apologize for the tight, circumstances we have this evening. We had an incredible response, and I'm sure it doesn't have anything to do with what's going on in the market. So we tried to accommodate as many people as possible. So you're going to go home with closer friends than you came with. And unfortunately, we couldn't have everyone here. But thank you to all for being here. You know, there's clients out here in the audience this evening, and I won't even admit how long that I've known them, because it will remind me of just how long I've been doing this. And lots of new faces as well, and there's guests. So I hope everybody's had a good evening so far. And we do have a great presentation. But before I begin, I would like to say a couple of words about the two new gentlemen on staff. And you know, the years go by really quickly. And you know, every New Year's rolls around, and at least I do, I kind of look back over the year. Very often, you kind of come to the conclusion, well, another year older, another year the same. And when we look back this year, some of the changes that we've made at 1015, it was a really, really big year for us, and we're really excited about 2019. I've had the privilege of working with Brad over the last several months in building the internal infrastructure to, onboard the tax service internally. And one of the main reasons that we did it was because we find that we have more tax planning needs year-round, not just tax preparation. And it's already come to fruition. He's helped all of us already in the last couple of months with questions that come up other than tax season. So I'm excited for all of you to get to know him, and it's one more service that we're really excited to have available. And Brad is an incredible guy, so we're excited about that. And as Mike said, for me personally, the addition of Brian Lomax. And here you can kind of get a feel, we work like a family, we work very closely, and people get nicknames. And of course we had a Brian. So what were we going to call the new Brian? And the first thing was we'll call him number 2. We decided that probably wasn't so good. But anyway, Brian L, or Lomax as he's known as internally, I cannot tell you how much depth and experience he brings to the investment management team. And timing to have him here over the last couple of months in such a volatile period of time, I can assure you we got another really steady hand at the wheel. So I'm really excited to have him on board. He's been exceptionally effective already, and I love working with him. I don't know that he'd say the same, but we're excited to have him on board, and it's just a really nice new face for 1015 Associates. So it's just going to be a great year. So that being said, I'm sure you're all interested in what we have to say this evening. And so without further ado, we'll get started. And for those of you that are new, we have a regular agenda that we'd like to follow. We're going to talk about where we've been, where we are, and talk at the end of this evening about where we're going in 2019. But again, for those of you that have been around for a while, we like to get your brains going. Hopefully you've had some food, had a couple of drinks, had some time to spend with your friends, and so we want to get your mind moving a little bit. So how long is the perfect book? 100 to 200 pages, 200 to 500, 500 to 1,000, or over 1,000? Well, according to bookreader.com, the best books are with 1,000 pages or more. But when they look a little bit deeper into the study, they find that maybe people who read books that long spend an awful lot of time justifying the fact that they didn't waste their time. And that if you go by the number of people who read books in a certain category, 200 to 500 would be the best category. And I think it's a great opening data point, because there we have the same set of data and we have 2 correct answers. In which country do people snore the most? In Luxembourg, the US, China, or Brazil? And I have no idea how they collected this data, but apparently it's in Luxembourg. And in addition to that, they found that the snoring patterns between age and gender differ as well. Us ladies, our snoring tends to peak out at about age 50. And unfortunately for us ladies, our guys just keep right on going. Not that I know from personal experience. And so which one of these is not a real business? A pet beverage brewery, a spa for guinea pigs, hang gliding tour for your dogs, or a 5-star hotel for cats? Well, you might be happy to know that you can take your dog for a beer. You can check your guinea pig in for a spa treatment, your cat into a 5-star hotel, but you cannot take your dog hang gliding. Last one, and for those of us who tend to overindulge, and especially at the holidays, which one of these categories would burn the most calories? Mowing the lawn, golf, grocery shopping, or sledding? Haven't done it in a while, but it's sledding. And down there at the bottom, if you can't see it, for any of you who still have the ability to get out there and pound the pavement, is the best calorie burning sport that there is. So now that we've kind of got your minds going, let's talk about what's been going on. 2018, from an investment perspective, would be like going back to the daily grind and irritations of life after a great vacation. And we can look at that by what happened in December. The bar chart here is indicating the percentage move on a daily basis during the month of December alone. We had the worst Christmas Eve in history. A half day of trading resulted in almost a 3% decline. For investors to come back the day after Christmas and give us the largest 1-point gain in history, gaining back 1,000 points or almost 5% in one day. And I ask you this, what changed? Nothing. Nothing changed. And December gives us, there's a lot of things that are going on during the month of December that really exacerbated these moves. Unfortunately, it doesn't make it feel any better when you're going through it. And December 19th, we had a Fed rate hike. And so that was kind of into a vacuum because the last couple of weeks in the year in our industry, most big fund managers, portfolio managers, and us included, there's a term, we kind of shut down our books. We're not going to make any big strategic changes to your portfolio in the last couple trading days. Because guess what? People are doing what they're supposed to be doing. They're home with their families. They're spending time on the holidays. They're not at their trading desks. Unfortunately, in this world, the machines are still running. And that's what you get in a December where the people aren't there, you've got headlines, and you've got machines that are going to run as long as the market's open. It was unusually calm in 2017, and I think that's part of what made 2018 feel as bad as it did. In 2017, we only had 8 trading days that the market moved by 1% in either direction. 2018, 64 days of more than 1% moves. Now, what's strange about that is that the average is actually 62. So 2018 wasn't necessarily exceptionally volatile, it was how quick it came and in the short periods of time that we got it, and again, following such an exceptionally calm year made it feel that much more difficult. If you look at the graph and you see that nice straight line going upward nice and comfortably, that's 2017. No volatility, no fear. The blue bars, that's the rates of return that we got in the 3 indices between 18% and 28%. Then you start to see all the volatility set in, which sets in fear, which sets in anxiety, and the market turned down, and you get the corresponding downward movement in all the major indices for 2018. there were very few things that worked. There were only 3 sectors out of the 11 sectors in the S&P 500 that finished the year positive last year: consumer discretionary, utilities, and healthcare. And there wasn't any place to hide in other asset classes. The international markets were down. The emerging markets were down. Gold was down, commodities were down, and REITs were down. Diversification didn't work so well. You went outside the United States, you likely got hurt even worse. The front part of the chart is the 5 best performing countries. Only 2 of them were positive. The US is right there in the middle. We were the 9th best performing country. The back there, the 5 worst. You're talking about losses of 38 to 41% in places like Greece and Turkey. So it wasn't unusual to see that the scope of negative returns, according to Deutsche Bank, as of October, 89% of the financial markets were negative. That's highly unusual to have that much correlation. Typically, you only get about a 30% correlation on the downside like that, so it was an unusual year. It was surprising that we had such a negative year given the backdrop of the fundamentals. We had 3 consecutive quarters that corporate earnings were up by more than 25%. That's almost unprecedented. And in the 3rd quarter, and we're just starting 4th quarter earnings right now, so we don't know how the final quarter ended up, but in the 3rd quarter, 78% of the companies actually beat the analyst estimates, and even in doing so, basically what was happening, if you beat the estimates in the 3rd quarter, yawn. Nobody really cared. And if you missed the estimates, you were pounded. So even though companies were reporting really good earnings, the volatility continued to increase as we made our way through the year. It wasn't unusual to see quotes like this. To say earnings have been anything other than stellar of late is to misrepresent what's happening in corporate America. The stock market, on the other hand, has clearly been expressing concerns about the downturn in the economy. What we have to remember is the stock market is a forward-looking mechanism, and that it is trying to price what's going to happen. So stocks will rise in value when they think the economy is going to get better. 2017, we had hope of all these things happening. By 2018, the stock market is worried about when will the slowdown come? And stocks are already beginning to try and price that in. What does it mean to PE ratios? And you can see that drop off in the very end there. Now, why do we care about PE ratios? We brought this up in prior discussions. PEs are one of the mechanisms that analysts will use to determine whether stocks look relatively expensive or inexpensive. So you have strong earnings and stock prices plummet. That means the PE ratios by the end, when everything was said and done in December, PE ratios drop below their 5-year and 10-year averages. Why does that matter? Investors begin to believe that there's value in stocks again. They become cheap relative to historic norms, may start to explain some of what we're starting to see in January already. So when PE ratios drop down like that, investors start to think that there's some value out there. And this part here, and yields, and you know I pay a lot of attention to interest rates. Every presentation, we're always talking about interest rates. And I'm going to call this the great rate debate. And the chart on the left, and I promise I've got a couple of charts, and I'm going to make you understand this. It's my goal this evening is to make you understand this next section. The left chart really isn't really consequential. That's the long-term chart of 10-year Treasury rates. I think what's important about that is how do we determine what's normal? We had rates way up high. You can barely see the fact that they've ticked up, and everybody's got themselves all worked up about higher interest rates. It's the chart on the right that I want to talk about. Because to me, this has a lot to do about the heart of the volatility that we've been seeing in the markets recently. So I'm going to walk you through this. Fed has been fully engaged, and the Fed has been raising interest rates. We got 4 rate hikes in 2018. In the early part of the year, you can see long-term Treasury rates, Treasury yields are rising. That makes sense, right? You raise short-term interest rates, and then you expect long-term rates to go along with it. Everything is going along fine. Remember, we hit all-time highs in the stock market in September and October. Kind of coincides with the peak in interest rates, doesn't it? Well, in October, the Federal Reserve told us that he's still got a lot of work to do. He's far from neutral, and he's going to keep on raising interest rates. Long-term investors said, oh my God, the Fed's going to go too far. He's going to raise rates too much. He's going to kill the recovery, and the economy is going to tank. So long-term interest rates started to head down. November, the Fed walks back and says, oh no, you know what? I think we're a lot closer to neutral than I thought before. And what does the bond market do again? Oh my God, rates have probably already peaked. I need to get some yield out there. I better buy some bonds. So you get all this buying of bonds, and what does it do? It drives yields even further down. Okay? Now, why is this so significant? Has to do with the shape of the yield curve. Now, I'm sure that you guys discuss the yield curve at dinner time like we do. In case you haven't lately, I'll give you a little refresher on what the yield curve means. And I promise you're going to want to know this in a couple of minutes. So the blue line and the black line is the yield curve in December of 2008 and December of 2013. So short maturities, if you bought a short bond, you get a low yield. And the longer you go out and you buy a long-term bond, you get a higher interest rate. And that makes sense, right? If you're going to take more risk by investing for the longer term, you should expect to be compensated at a higher rate of return. And the world works pretty well. You know, and the banks can make money. You deposit your money, they pay you the short-term rate. You go in and you borrow money, you've got to pay the long-term rate, and they make the difference. Nice, healthy economy. That orange line or yellow line right there in the middle, that's the yield curve in December of 2018. There's no difference. Short yields and long yields basically the same. And right in the middle there, and you probably might not see it, but there was what we call an inversion of yield curves. Well, now by now you're probably saying, speak English. Okay? So an inversion means that long-term interest rates dropped below short-term interest rates. And this happened on the 3s to the 5s, and you know, analysts don't really care that much about it. But when you look at that flat line, and you assume that the Fed continues to raise interest rates, that means you're going to get higher short-term rates and lower long-term rates. Okay, so if long-term rates continue to fall or the Fed continues to rise, we get an inverted yield curve. Okay, so why does everybody care so much? Well, analysts pay a lot of attention to this. And I'm going to make this English. This is the difference, or what we call the spread between the 10s and 2s. Okay? Now, early part of that graph, let's say about 1985, if it's that first third, the spread between the 10s and the 2s, that means the difference on the 10-year Treasury versus the 2-year Treasury, there's about a 1.5% difference. Pretty healthy. It starts declining, declining, declining. You see that black line? Breaks through the black line. That means it went negative. We've got an inverted yield curve. You see the gray little line, the parallel line that follows? That's a recession. Go up to the next peak. See it come down, come down, come down. See it breaks through 0. Inverted yield curve. See what follows it? That next gray patch? recession. 2004, rates spread drops precipitously, turns negative. 2006, you got it now, don't you? Recession. Okay? So that's why the market is all worried about what's going on with the yield curve. Because it can, and remember, I want to remind you this, the 10s to 2s have not inverted. This has not happened. We're not worried about a recession right now. But when you start reading the news over the next couple of months, and if the Fed wants to continue to raise rates and long-term rates continue to decline, the market's going to get nervous about that. And that's why. Every time since 1956 that the 10 to 2 yield curve is inverted, a recession has followed. So an inverted yield curve can mean that we're going to get a recession. It may simply mean that the Fed's next move will be to cut rates, not continue to raise rates. It may mean that inflation is going to be lower in the future. And it may also mean that investors are going to move away from risky assets and want to be in safer assets and own more bonds. So in inverted yield curves and what's happened in the bond market since that peak of interest rates and the peak in the stock market, to me, gives me an awful lot of insight about why the market has been as volatile as it has. So if I haven't lost all of you yet, let's talk about where we are now. So maybe we need a little bit of light-hearted data after something quite that tough. What about the etiquette of selfies? Any of you guys good at taking selfies? I haven't quite mastered it. But so they did this study, and again, I'm not sure who spends their time doing this, but at most age categories, they find it acceptable that you take selfies at a concert or at a tourist attraction or a wedding or something like that. But, you know, it is kind of surprising that people under the age of 55 actually think it's okay to take a selfie in the bath. Okay. But everybody kind of agrees that it's not okay to take a selfie at a funeral. So, what about the US? What does the US look like if we were to take a selfie of the US right now? This graph, I think, will surprise you. The blue bars represents periods, the numbers of months that the economy has been in an expansion. The orange or yellow line represents the period or the number of months that the economy has been contracting or that we're in a recession. I learn very well visually, and it's pretty easy to see we typically get very long periods of expansion followed by short, more abrupt periods of recessions or contractions. This may have a lot to do with what we call loss aversion. And I think we need to give a lot of credit to the psychology of the markets and think about how people behave based on how they feel. And you know, if the month of December didn't literally take you to your knees, then I don't know what will. And so we have to think about how people are feeling and how it motivates them on their decision making. And what loss aversion is that they have found that people feel that the loss from a decline or the pain that they get from a loss is much greater than an equal benefit from an equivalent gain. So that if you were to give somebody equal probabilities, a gain versus a loss, they won't take the risk. They'll step away from the risk. And they actually did a study of undergraduates. And they said, on a toss of a coin, which is 50-50 odds, right? They would not wager $10 unless the gain was at least 30. So loss aversion and this fear of what a loss will mean to us is one of the reasons that we can understand why people are so afraid of bear markets. Oh my God, what if I were to lose money? But let's take a look at the numbers. The blue periods represent bull markets. The orange pieces represent bear markets. The average bull market lasts for 9.1 years and has produced an average of a cumulative gain of 480%. The average bear market has lasted for 1.4 years and produced an average loss of 41%. Now, 1.4 years and 40% is some serious damage, right? But if you were in the bull market and you made 400, that's only 10% of your gain. Now, timing in life is everything, right? How many people do we meet and they say, as soon as I invested, market's going to go down? And so again, it's about being properly diversified. But again, if we can keep in perspective, again, this loss aversion, and we're all humans, right? Fear of loss is really overwhelming. So we'll put it in perspective. Bear markets have just not been that bad. So again, part of the volatility is everybody's trying to guess when this bear market's going to be over, because you don't want to be the last one out, right? So everybody's trying to figure out, when do I get out? So one of the things that we can look to is, how do you predict a recession? And one of the ways is to look at the business cycle. And we've looked at this chart in the past. And right now we can see that China is arguably either in or very near a recession. And that the US today is still in the latter part of an expansion. And we know that during the latter part of the expansion, things like rising interest rates and rising wages and tight employment markets will start to cut into profitability. The problem is, it's actually very difficult to predict a recession. They say it's almost nobody can get that right. We're actually in recessions 10 to 12% of the time. So they're not that unusual, but the ability to predict them, one reason for the failure might be that recessions occur following economic crises, which in themselves are difficult to predict. And where are we right now in 2019? Well, there's a lot of crises that people are worried about. This chart here, again, on the vertical axis, it is telling us the probability that any one of these things may in fact happen. The horizontal axis is telling us how damaging that event would be to the markets. So we want to look at the high dots and the ones far out to the right, the most damaging with the highest probability. No surprise out there, right? Global trade tensions, US-China restrictions, and the Russia-NATO conflict. And even as recent as today, there were headlines late this afternoon that possibly the US was going to lift some of the tariffs on China to get closer to a deal. I don't know whether there's any substance to this or not. Maybe it was fake news, I have no idea. But the market reacted to it. But all of these things are going on out there, in addition to Brexit, in addition to populism, in addition to, what are we, day 27 right now that the government's shut down? So we got all of these things that the market is literally trying to price in on a day-to-day basis. So it shouldn't be any surprise that by the end of 2018, that investors' attitudes had changed pretty dramatically. The green line is representative of the amount of bearishness in the market. Bearishness actually went above historical averages. And guess what? The bullishness is the blue line. And by December, bullishness had really come down and had dropped below historical averages. Now, we've talked about this before, and that this type of graph is typically representative of a contrarian indicator. So maybe, again, this is no surprise. If investors got that bearish, the market would be oversold. Again, we talked about PE ratios coming down. And what are we seeing in January? We're seeing this market start to come back up. But sentiment definitely took a change for the worse. So where are we going from here? Well, contrary to popular belief, I will tell you that money, in fact, can buy happiness. It's just a matter of how you spend it. And so there is actually a book, The Science of Happy Spending. And lucky for you, we've digested it down into 5 principles for you. And we'll share those with you tonight. By experiences. Material things don't last. The happiness we get from them doesn't really stay around that long. And I think that's one thing the millennial generation really has right. They want to live for experiences. Make it a treat. If you take something for granted and you do it all the time, you don't get as much happiness out of it. I say even simple things. You know, if you go out to dinner every single night, there really isn't much enjoyment in it. Go out for a real nice dinner once or twice a week and really enjoy it. That's different. Buy time. I'm not talking about, I wish I could buy time. You know, if we got 26 hours a day, that would be nice. But what this really gets to is pay people to do the things that you don't enjoy doing, to free up your time to do the things that you actually really enjoy. Pay now, consume later. You know, people tend to not overspend if they have to pay up front. And I always say it reminds me of, you know, going on a great vacation. You know, if you pay it in advance and you have that time to look forward to it, I'm going to enjoy it, a lot of enjoyment comes from it. But when you go on a vacation and you're just sitting there waiting for those credit card bills to show up, not so much fun. And the last one is invest in others. And I'm going to call this the joy of giving. And looking around the room tonight, we are fortunate to work with a lot of very successful people. And people who have chosen over the years to help out the people around them. Whether it's to help a grandkid with a college education, help a child buy their first house, all those things. And the joy that we can get from helping others who need it more is incredibly powerful. So no matter how you choose to spend your money, it's going to help the economy. We as consumers represent 2/3 of GDP. And there's a lot of expectations that 2019 is going to be the year of the consumer. We know that businesses are already getting nervous. They're worried about an awful lot of things. But this is the first time in a long time that people feel really confident about their jobs. They're getting raises. They're feeling good about things. And people are out spending. The economy this year is expected to grow at about 2.5%, which is a slight downgrade from where it was before, but it's still growing. And there are areas around the world that are actually growing very, very fast. And this will be one of the things that we're going to have to take into consideration in our investment themes this year. Either owning those countries directly or making sure that we invest in companies whose products have exposure to some of these markets that are growing much more quickly than the US is. It's expected the emerging markets in particular should do very well. They've been hurt by rising interest rates in the US. They've been hurt by the strength of the US dollar. They've been hurt by the trade tensions that are around the world. They've had to become very fiscally responsible, puts them in a position to recover very, very well. So looking to some of those economies in 2019, I think will be something that we need to take into consideration with your investment dollars. The US performance gap should subside. The higher dark blue line is the performance of the US markets. The lower line is the emerging markets, foreign markets. You see, earlier on in the year, everybody was kind of trading in tandem. All of a sudden it splits. There was a clear preference. Remember I said the US was the 9th best? I mean, we were better than, even though we were down, we were still much better. Strong preference. We're the strongest economy in the world. So people had a strong preference for US stocks during 2018. In 2019, we could see that gap start to narrow, where investors will put money in other countries outside the US. This graph, by the way, is only updated until October. We've actually started to see those lines converge. Those types of extremes typically don't last for a long time. So when we look at those things, it tells us where we should be looking for opportunities. Value stocks may make a comeback. The last decade has been what I call the decade for growth, that investors have been really willing to plow dollars into companies where they hope they'll have strong future earnings. They hope they'll have strong future earnings. Value stocks are much more appropriate for retirees and more conservative investors. They're companies that are trading at a very good price relative to their ability to produce earnings. Those types of stocks have been out of favor for the last decade. We could see a resurgence of investors wanting to own those types of companies, which would be really good for the type of names that we like to own. This chart, by the way, shows that the period from 2016 to 18 is one of the widest divergence that we've seen in history of growth versus value. And just like with the emerging markets, you expect those gaps to close over time. So a strong area that we want to look to is value. I don't think this is something that is talked about quite enough. It doesn't get a lot of attention. Do you know that the amount of public companies has declined substantially? In 2007, there were over 5,000 publicly traded companies. Last year, there were a little over 4,000 publicly traded companies, representing a 20% decline in the number of companies that we have to choose from. In addition to that, companies have been aggressively buying back their own shares. So the number of shares that are out there for investors to buy has dried up as well. We talked about coming to toward the latter part of an expansion. If you're a private company today, do you want to wait until the recession comes to bring your shares public? We will likely see a lot more companies kind of move along the line of bringing their companies public. We'll broaden the horizon of companies that are available for us to invest in. So as we worry about what's going to happen, let's talk about what the experts, so-called experts, have been saying. According to Barron's, investors will soon bid good riddance to 2018, a stressful year marked by 2 stock market corrections, rising interest rates, an ugly trade battle, and growing fears that a bear market lies just around the corner. According to this group, their mean prediction for the S&P 500 this year is 2975, which is a 14% increase. Now, Brian's done a lot of work on a capital markets outlook. We're not that quite optimistic. We do see a positive year for 2019. If I got half that number in an economy that's really faced with a lot of challenges, I'd be happy with that. They're telling us 14, I'll take it. In addition to that, from Liz-Ann Saunders from Schwab, and this is really interesting. We've been in a stealth or rolling bear market for much of the past year, with short volatility strategies, FANG stocks, emerging markets, and oil, all in bear markets. Even though the S&P overall is not in a bear market, almost 50% of the S&P 500 was down 20% or more. That gives you an idea just how tough it was out there last year. And although we don't see a recession right ahead, we could see the bear market unfold in this manner rather than all of the indices coming down all at once. And that's something to really look for, because it means that there's pockets that are working throughout the year, that you don't get the entire market come all down as one. And that's a lot what we saw last year. And according to BlackRock, we expect global growth to slow next year and see U.S. growth stabilizing at a much higher level than other regions, even as the effects of the 2018 fiscal stimulus fade. Markets are vulnerable to fears that a downturn is near, even as we see the actual risk of a recession in 2019 as low. And this, which I think is really important to the grain of what we do, according to Bob Arnott, people hate diversification in bull markets. At the tail end of what is now the longest equity bull market in history, this is not a time to worry about the drag imposed by diversifying asset classes. And that's something that we highly believe in getting through good times and bad. So I think this is kind of sums up 2018. The stock market fell sharply today, then bounced back, spiraled upward, jumped forward, leaped to new heights, tumbled rapidly, and took first place in a gymnastics competition. Not the way we like to see our retirement dollars behave. And I think most importantly, remember some of those charts. Bull markets will come, bear markets will come. You think about the time span of those things. It is really important to keep focused on long-term strategies and understand that things will go up and come down. But what we're looking for in 2019, volatility is likely to continue. All of those things that we talked about creating the volatility, I don't see any of them going away anytime real soon. So the bad news tonight is volatility is likely to stay. The economy is going to remain strong. You know, the trajectory looks good. We're in the middle. We're just starting earnings season right now. We'll get a real good look at what fourth quarter looked like. Late cycle pressures will begin to weigh on profitability. The markets will move higher, but worry about the slowdown ahead. Non-US markets may outperform. The Fed is likely near or done raising interest rates, and a potential catalyst from trade resolution at some point. So we hope that kind of sums up all that we've been seeing over the last couple of months, and now you fully understand what's going on. And we thank you so much. Have a wonderful evening.